All right, let's get more on the banks with Chris McGratty, head of U.S. Bank Research at KBW, a Stifel company. The firm announcing just in the last hour that he is taking over coverage of large cap banks, upgrading several names, including Morgan Stanley and JPMorgan. Chris, great to have you with us.
Melissa, good to see you.
Let's start off with the upgrades or the move higher in the ratings with your initiation of coverage. JPMorgan, for instance, we were talking about in terms of the valuation. Do you need to see a re-rating of banks in order to justify an overweight basically here at close to record levels?
You are seeing a re-rating, right? This re-rating has been occurring for the past couple months, right? Deregulations being built into earnings estimates, upside scenarios, blue skies. And the reality is the upside scenario is becoming more of the base case scenario. So you've seen the Universal, the largest 6 banks, lead the charge. We've gotten a lot of positive news on deregulation. And that's one of the 3 themes with this launch is deregulation. The other 2 themes are scale and consistency. And any way you check it, the largest banks have all 3 and they're the relative winners. That doesn't mean you're not going to see a catch up on the small and mid cap banks and the regionals because they've lagged so much, but there's clear moats around the largest banks.
So, for instance, JPMorgan, which is now at a 2.4, roughly 2.37 price to book. What kind of price to book would you see? I mean, historically, that is high relative to itself.
It is. It's high. It's a premium and it's well earned, right? The company through the cycle is talking about a 17% return on equity. Last year, they did 20, right? So this is a company that's going to generate a high teens return on equity. And that's even before the windfall from capital from deregulation. So the book value multiple definitely is expensive. But if you look at the earnings multiple, it's trading at a 10% premium to peers. Over the past 3 years, it's trading at 12%. So great companies trade at good valuations permanently. And I think JPMorgan at a 10% relative PE premium is quite reasonable.
Chris, it's Karen. Thanks for being on. So I'm long, but I'm just going to play devil's advocate for a little bit. I understand the premium isn't so high on JPMorgan, but the absolute number at 15 with the market at, 21.2, that's kind of a high ratio. I know banks have always traded cheap relative to the market. Does that concern you at all, or is the chance that we could break out from that long-time trend of trading at a big discount to market multiples?
Yeah, the absolutes are something we watch. We watch the relatives a lot closer, right? If you think about the largest banks, we're trading, in the low 50s to the S&P. So the S&P is at high valuations. The long-term average for the banks to the S&P is closer to 60 if you go back 10, 15 years. And so the absolutes are something we're watching. The momentum is something we're watching. There's a lot of momentum in the large cap banks. Sure, they could pull back. But again, a mid-teens PE multiple for the earnings. JPMorgan's a growth company, right? It's the largest bank in the country. But if you think about the revenue growth this company is delivering, they're generating solid revenue growth and positive operating leverage across its business.
Chris, Jane Fraser seems to be turning Citi around. I mean, all of her plans, all the implementation seems to be working. I don't think they're getting credit for it yet. Do you agree with that?
I mean, the stock's 80% of book, so there's not a lot of good news priced in, Guy. If you think about their guide, their 10 to 11% ROTCE guide for next year, they took that down earlier this year, so the bar has been lowered. But if you look at where expectations are, right, the street, and we're in the low to mid 9s. So there's a big gap between low to 9s and to 10 to 11. So if they can get that right, it's the cheapest stock in the group. They've got a buyback catalyst. It's very accretive when you can buy your stock back below tangible book value. And so this deregulatory environment for Citi is hugely helpful. Now, they put the pieces. The reason the ROE is so low is the expenses have had to play catch up. That investment phase is done. And so what the company's doing now is they're generating revenue. They're generating positive operating leverage across their businesses. And if they can get the macro to settle in a bit, this is a company I think we can re-rate quite a bit.
Chris, I know every bank is different, but how are you thinking about corporate credit, consumer credit, and then kind of rates on the long end of the curve and how that plays into your theme?
Hey, Danny. The higher rates are good for a lot of our calls, but again, higher rates to a point, right? You don't want to see the long end, and that was the fear in April. The long end was getting out of control a bit, and you started to see the credit discussion leak back into the narrative. Now, the long end's calmed down a little bit. Credit's been pretty good. Spreads have compressed a bit. We're not as worried broadly about credit. And again, we may see some reserve building this quarter. That's possible. The banks have told us that. JPMorgan did it last quarter. Citi is likely to do it this quarter. But again, the balance sheets are in such a great spot from a credit perspective today versus what were preconditioned from GFC.